In the latest edition of the Canso Market Observer, we address recent challenges in the front end of the U.S. financing market, also known as the repo market. The Federal Reserve has had to intervene on numerous occasions to ensure the orderly function of these markets. Analysts, as they attempt to describe what's going on in the repo market, often cite technical factors. Technical factors is another way of saying we have no idea what's going on in the repo market. At Canso, we think the answer is quite simple. Too much supply of government debt and not enough cash to pay for it. This simple supply-demand equation explains the indigestion in the U.S. repo market. The chart shows the ratio of outstanding U.S. Treasury bonds, excluding short-term T-bills, versus the amount of money supply, or cash in circulation, known as M1. In the early 1980s, the ratio of Treasury bonds to cash available to purchase these bonds was roughly equivalent, or just above 1-to-1. From the early 80s through to the mid-90s, this ratio gradually increased as the pace of borrowings modestly outpaced the growth in money supply. Under the Clinton administration, surpluses allowed for a reduction in national debt, briefly reducing the ratio to below 2-to-1. During the credit crisis, fiscal measures undertaken by the government resulted in new borrowing increasing at nearly double the pace of M1, taking the ratio to just under 4 times in 2013. The chart makes us wonder what will happen if investors just stop buying. At about 3.5 times the amount of debt versus cash, this suggests ultimately Treasury bond prices could fall as supply greatly outweighs demand. This isn't just a problem for the government bond market. Given low returns offered by conventional investments, investors have flocked to very speculative, often illiquid investments, driving prices to unsustainable levels. For more information on the repo market and other market insights, please read the Canso Market Observer, available at cansofunds.com.